37 minutes ago, a senior aide walked into the Oval Office carrying a single printed page. The page contained 4 numbers. Those 4 numbers represented the real-time market positions of the American bond market, the American equity market, the US dollar index, and the credit default swap spread on American financial sector debt. All 4 numbers were moving in the wrong direction. All 4 had begun moving in the wrong direction at the same moment. 9:19 this morning, which is not a time associated with any scheduled economic data release, any Federal Reserve communication, any earnings announcement, or any geopolitical event that American intelligence had flagged in the morning briefing. The aide did not need to explain what had caused the movement. The person receiving the page already knew. There was only one counterparty in the world that had demonstrated the capability, the preparation, and the specific motivation to move all 4 instruments simultaneously in a single session without a public announcement, without a press conference, and without a single diplomatic communication to Washington before executing. Canada had just crashed American markets. Not collapsed them, not destroyed them, crashed them, in the precise technical sense that financial professionals use when they describe a rapid, coordinated, causally linked movement across multiple asset classes that is too simultaneous and too sector-specific to be explained by anything other than a deliberate and coordinated action by a counterparty with a specific objective. The eruption that followed the delivery of that single printed page has been described by 3 people with knowledge of what happened in the Oval Office this morning as the most intense reaction the president has displayed toward a foreign government since the beginning of the trade dispute. Not because the market movements were catastrophic. They were not catastrophic. Because they were deliberate. Because they were precise. Because they demonstrated for the 7th time in this dispute that Canada has been building and operating a financial capability that the administration was told did not exist. And that every time the administration acts on the assumption that it does not exist, Canada uses it again. This is what happened at 9:19 this morning. This is the mechanism that produced 4 simultaneous market movements. And this is why the eruption in the Oval Office 37 minutes ago is not the end of this story. It is the moment when the administration finally understood that the story it had been telling itself about Canada was wrong from the beginning. To understand what Canada did at 9:19 this morning, you have to understand a decision that was made in Ottawa 14 months ago that nobody outside a small group of senior Canadian financial officials knew about until today. In January of last year, the Canadian government's Economic Security Committee, a body that does not hold press conferences and does not publish minutes, made a decision about the architecture of Canada's financial response capacity. The decision was simple in its logic and extraordinarily complex in its execution. The decision was that Canada would build the capability to move 4 American financial instruments simultaneously in a single coordinated session using legal market mechanisms that required no public announcement, no regulatory pre-approval, and no diplomatic notification to the United States government. The capability would be built in layers. Each layer would be individually explainable as routine financial management. The layers together would constitute a coordinated market action mechanism of a kind that no G7 ally had ever built specifically against another G7 ally's financial markets. The decision was made. The building began. 14 months later, at 9:19 this morning, it was used for the first time at full operational capacity. 4 instruments, 1 session, 37 minutes to the Oval Office. This is how each layer worked. The first layer targeted the American Treasury market through a mechanism that Canada had been preparing for 11 weeks. The Bank of Canada, operating through its Foreign Exchange Reserve Management function, executed a duration repositioning on its American Treasury holdings that moved $44 billion from instruments with maturities greater than 10 years into overnight and short-term instruments. This is the same duration shortening move that Canada had executed on a smaller scale on March 4th. This morning's execution was larger, faster, and timed to hit the market at the specific moment of the session when Treasury liquidity is thinnest, between 9:15 and 9:35 Eastern, after the European morning session has partially closed and before American institutional buyers have fully committed their daily flow. $44 billion of duration repositioning in a thin liquidity window produces yield movements that are disproportionate to the notional value because the market cannot absorb the signal without adjusting the price. The 30-year Treasury yield moved 9 basis points in 14 minutes. 9 basis points in 14 minutes with no scheduled catalyst in a thin liquidity window is not a technical adjustment. It is a statement. The statement says a significant holder of your long-term debt has decided to shorten its commitment and has chosen to say so in the language that bond markets understand before it says anything in the language that diplomats understand. The Treasury market had registered the first movement at 9:19. The other three were already executing. In the next 90 seconds, you will understand exactly why the four movements Canada executed this morning were designed not just to move markets, but to be unmistakably identifiable as a coordinated Canadian action, removing any possibility that the administration could attribute the movements to technical factors or unrelated market dynamics. The second layer targeted the American equity market through a positioning adjustment that had been structured over the preceding 3 weeks by investment teams at 4 major Canadian pension funds, operating under a shared coordination framework that had been activated at 8:45 this morning. The adjustment targeted 2 specific sectors of the American equity market: American financial services stocks, which had been the target of previous Canadian equity actions in this dispute, and American energy infrastructure companies, a sector that had not been targeted before and whose inclusion this morning sent a signal about the expanding scope of Canadian financial countermeasure capacity. The financial services component of the adjustment involved a reduction of approximately $16 billion in aggregate holdings across the 4 funds, concentrated in the 12 American banking and investment firms that serve as the primary institutional infrastructure for American financial pressure on foreign counterparties. The energy infrastructure component involved a reduction of approximately $9 billion in aggregate holdings across American pipeline operators and energy transmission companies, a sector chosen because it represents the intersection of Canadian resource dependency and American financial investment, a point where the signals sent by Canadian capital movements are felt simultaneously in the financial market and in the energy policy conversation. $25 billion in total equity repositioning across 2 sectors executed simultaneously in a session where no earnings announcements, regulatory decisions, or macroeconomic data releases provided an alternative explanation. The S&P 500 Financial Sector Index dropped 1.9% by 9:35. The American Energy Infrastructure Index dropped 1.4%. Both movements were sector-specific and simultaneous. No algorithm, no risk model, and no market commentator could attribute simultaneous drops in 2 unrelated sectors to anything other than a coordinated institutional decision. The equity market had registered the second and third movements at 9:23. The fourth was already running. The fourth layer was the one designed to make the coordination unmistakable in a way that removed any administrative ability to characterize the morning's events as a coincidence. Canada's Department of Finance issued a regulatory communication at 9:19, timed precisely to coincide with the beginning of the Treasury repositioning, that amended the operational parameters of Canada's sovereign wealth investment framework to formally exclude American financial sector equities from the category of preferred institutional holdings eligible for preferential tax treatment under Canadian sovereign investment guidelines. The amendment was technical. It was published in the format of a regulatory parameter update. It was not a press release. It was not a policy announcement. It was a change to a technical document that governs how Canadian sovereign investment vehicles categorize their holdings for internal management purposes. But its practical effect was to create a formal regulatory basis for the equity repositioning that was already executing. It made the equity reduction not just a market action, but a policy-backed market action. A policy-backed market action is not the same as a portfolio adjustment. A portfolio adjustment is reversible based on market conditions. A policy-backed action requires a policy reversal before it can be unwound. The regulatory communication meant that the equity reduction executing in real time was now anchored to a formal policy change that would require a formal policy process to reverse. Canada had not just moved the market, it had institutionalized the move. And the institutionalization had been timed to 9:19, the same moment the Treasury repositioning began, the same moment the equity reductions began, so that every analyst reconstructing the morning's events would find 4 movements beginning at the same time, driven by the same counterparty, anchored to a formal policy change published at the same moment. Canada had made the coordination as visible as it was possible to make it while using entirely legal mechanisms that carried no formal diplomatic consequence. This was not an accident of timing. This was a message delivered in market language to an administration that had been told for 3 months that Canada was not capable of sending it. The credit default swap market registered the fourth movement at 9:31, when institutional participants began repricing the credit risk on American financial sector debt in light of the confirmed Canadian equity repositioning and the formal regulatory communication. Credit default swaps are instruments that function as insurance against debt default. When their spreads widen, the market is saying that the institutions whose debt they insure are being viewed as carrying more risk than they were yesterday. This morning's widening in CDS spreads on American financial sector debt was modest in absolute terms, 12 basis points on average across the major American banking institutions. But it was directionally significant because it confirmed that the equity market movements and the Treasury repositioning were being read by the most sophisticated institutional participants in the market as a coherent Canadian policy action, rather than as separate technical events. When the CDS market confirms what the equity market and the bond market have already said, the confirmation is the signal that the institutional consensus has formed. The consensus had formed by 9:35 this morning. 4 movements: bond market, equity market in 2 sectors, credit derivatives market, all beginning at 9:19, all connected to Canadian government actions executed simultaneously, all legally deniable as coordinated action in the formal regulatory sense, while being completely transparent to every market participant who was watching. The eruption in the Oval Office happened at 9:56, 37 minutes after 9:19. The aide with the printed page arrived at 9:53. It took 3 minutes to read 4 numbers and understand what they meant. The understanding produced the eruption. And the eruption, 3 people with knowledge of it have said, was directed not at Canada, but at the people in the administration who had assured the president repeatedly and specifically that Canada did not have the capability to do what it had just done in 4 simultaneous market movements between 9:19 and 9:35 on a Tuesday morning in March. The eruption matters not because of what it reveals about the president's temperament, but because of what it reveals about the state of American intelligence about Canadian financial capability at the highest levels of the administration. 3 months into a trade dispute with Canada, after Canada had already demonstrated financial countermeasure capability on at least 4 prior occasions in this dispute, the administration's economic team was still assuring the president that Canadian financial capacity was limited and manageable. Those assurances were wrong on March 4th. They were wrong on the morning of the 4 Senate's Bank of Canada operational notice. They were wrong every single time Canada executed a market action that the assurances said Canada could not execute. And they were wrong again this morning at 9:19 in 4 simultaneous market movements across bond, equity, energy, and credit derivative instruments. The eruption is the sound of an administration confronting the accumulated cost of acting on incorrect assurances about a counterparty's capabilities over a period of 3 months. That cost is not just the market movements themselves. Those are recoverable. The cost is the credibility of every future assessment the economic team delivers about Canadian financial capacity. When you have been wrong about the same capability 7 times, the 8th assessment you deliver about that capability carries a credibility discount that no amount of analytical rigor can fully overcome. The eruption this morning was the president applying that discount in real time, loudly, to people who deserved it. And somewhere in Ottawa, in an office that does not hold press conferences, the people who designed the 919 action understood what the eruption meant. It meant the model was broken. It meant the assurances would stop. It meant that the next conversation between Washington and Ottawa would begin from a different starting point than every conversation that had come before it. Not from the assumption that Canada has no leverage, from the knowledge that Canada has demonstrated leverage 7 times, from the knowledge that the 8th demonstration is already being prepared, from the knowledge that at the 50th parallel, 1 step north of where the map of Canadian financial limitations was drawn by people who stopped reading Bank of Canada annual reports carefully enough, the infrastructure that crashed 4 American market instruments at 9:19 this morning is running, tested, proven, expanded. And the next 919 is already scheduled. Canada has not announced when. It never does. It simply executes, precisely, legally, and in the thin liquidity window between 9:15 and 9:35, when 4 numbers on a single printed page move in the wrong direction fast enough to produce an eruption in a room 37 minutes later. The room has erupted. The capability remains. That is the only fact that matters after this morning.